Today I'm going to go over a red day, which is actually my second red day this entire month, trading in May during this choppy price action, and just maybe not the best price action we've seen ever. But again, this is still tradable as long as you can adapt to market conditions, and or if you have a very robust trading system or strategy like mine. I'm going over this red day. This is a -1R red day. It's not a huge red day, and this is something you really guys need to understand as traders, which is you want to keep your red days as small as possible and let your green days grow and ride and carry the account. We had about 19 active trading days this month because I know we had Memorial Day as a holiday, and typically in a trading or in a month, typically you will have 20 active trading days, excluding obviously the weekends, right? So two red days basically this month for me personally. The other red day was I think 2 weeks ago or a week ago. I also had a red day, and I believe it was a -1 or -2R red day. I'll double check, but I have a video or posted in a Discord about the red day as well. But nonetheless, this is about an 89% green to red ratio so far in terms of green to red trading days for me this month. So I did a very good job this month, in my opinion, personally, on managing through these market conditions when a lot of people online seem to be losing their brains and losing their mind, because I won't lie to you, this is not the best price action for the majority of the month. Towards the end, we have started getting something a little bit better, but still not great, right? But anyway, going over recapping these trades. I'm gonna see if there's anything I'm missing here in terms of notes. Should be nothing here. Okay, we actually had FOMC meeting minutes, which isn't as important as the actual meeting for news. I didn't see it later until way later actually, but it didn't really do much. We basically just chopped a ton right before FOMC. And if you guys have traded FOMC, you also know that typically when we do have FOMC, price will have bad price action up until FOMC meeting minutes. And the reason why is because think about your typical red folder news. It's typically at near the opening, so at 8:30 a.m. EST, and a lot of people are not trading before 8:30 a.m. EST. So people trade right after news typically. Most people don't trade right before news or right before news is about to get released. So people wait until news basically releases, especially if it's red or orange folder. So that's a way you can logically think of why we tend to get bad price action or choppiness or just straight consolidation and barcoding before meetings that occur later or red folder news that occurs later. Like basically FOMC is the most common red folder news that occurs later, which is literally at 2 p.m. EST. Every single time we do have FOMC. Most other news releases you guys know is literally 8:30 a.m. or 10 a.m. EST. The majority of that's basically the common ones. You just have to really know in terms of timing. But of course, always check Forex Factory before you start trading. I just did not, fortunately, and I paid the price for it. So in this day, I'm gonna actually go in replay mode so you guys can see this clear with the indicators and such. Let's see if I'm missing anything here. All right, nice. So yeah, all these trades here, personally, in this day, were basically taken within the kill zone. We had very good price action in the morning. I'm gonna see if there's any sweeps on this day. This was yesterday. We had 8 or 7 sweep. But the most important sweep here, really, I'm gonna take off the kills indicator, is we swept previous day high before market open. So you had a nice short here. Again, I was not trading or looking at the charts at this time, but there was a nice short there. You could also make money here, counter trending this trend, bullish trend. But what is my main confidence on this first trade here? This is an A+ setup to me, and I'll explain why real quick, even though this looks like it's counter trend, right? Here we have high time frame liquidity taken out, which is previous day high already. And we've also had 2 break structures to upside, which if you guys know from the course videos, modules, I have a 2 to 3 structure break rule. And so that followed this rule perfectly. And also price is basically going more and more in premium. You guys have to understand, price does not continuously keep going one direction. At some point, it will hit a high time frame POI, daily, 4 hour, 1 hour, sometimes 30-minute, and it will reverse direction. And we can anticipate that reversal using those high time frame POIs. Hence why it's important to cycle, or at least understand where your high time frame POIs are in the chart. If you don't have an indicator like mine that auto marks them, you really want to pay attention to where they are and look for them yourself. So here, this was just a trade off the 1 hour supply. And I'm gonna show you guys real quick what that looked like. So right here, this is the 1 hour supply. And you can see how we tapped into it perfectly after we had a 1 hour external continuation here. That's basically one break there, two breaks. We had a third break right there on the higher time frame, and on a lower time frame we also had about 2 to 3 breaks going to the upside towards our PY. And you can see, like I said, if you guys know the sauce, you know, in the course I mentioned this, why we don't typically, or try to sometimes, basically, especially if it's before like volatility, in terms of before the kill zone, in terms of, for example, when your stock exchange opens at 9:30 a.m., which you kind of want to wait for. Otherwise, we typically don't get big moves outside of kill zones, right? So like if we're in a high time frame PY, you typically, as a general rule, it's not a strict rule, but generally you want to preferably be within a kill zone timing when there's high volatility, because otherwise there's not enough volume for price to really push off that POI. You can see why we failed here earlier. This is before the New York Stock Exchange opened, and you guys know indices are extremely crucial in terms of the correlation to New York Stock Exchange. It's the biggest exchange in the entire world, literally, basically. So hopefully that makes sense there, why this was the true move here that we should be catching, not this. If you do trade this, you trade it down to a conservative TP, guys. You don't look for massive targets like you're trading the higher time frame. And again, I also mentioned this in the course video where literally we tend to get this sweep, you know, before in a high time frame POI for the most part. So this is a short here. The entry model, you can use whatever entry model you want here. Honestly, this is not an entire impulse model delivery here, so I probably would not use impulse model here, even though we did have a very big impulsive candle if you want to count this, but this would just not be an A+ impulse model. And I tend to stay away from impulse model unless for 2 reasons. And these 2 reasons are, if my drawn liquidity is extremely clear and I have a very high conviction in this POI holding based on other confluences prior to price hitting the POI, or number 2, how price delivers towards my POI. Those are really the only 2 basic main reasons why I would ever risk an impulse model. Because with impulse model, you basically are guaranteed to catch a trade, or you are guaranteed to catch every single trade. That does go in your favor, obviously. So hopefully that does make sense. I took an IFG setup here. We actually had one on NQ, but here, I'll show you guys real quick. 28th. Where's 28th? This is 28th on 9:30. Whoops. 9:30. Right here. I know it's a little messy with my 3 chart variation, but on NQ, the stop loss was bad, man. I would have been up. Like the trade would have been a 1-to-1 on NQ, and this is something you have to boom. You have to make decisions quickly when you're trading. This is a skill that you basically master when you're live trading that you can't in backtesting, right? Because you're making these split decisions that have 2 options at times immediately. And you can see, even though these are the same exact trade ideas, 945, both 945 candles with the same stop loss basically, above this bullish candle here, right here. As you can see, because that's a pullback right here, that made an internal break of structure fractally on probably the seconds. And you can see the risk reward difference, man. It's a 1-to-1 versus a 1-to-2. This is something you just have to eyeball out, or if you have time, draw it on the chart and just go and immediately execute this trade, man. Just go and immediately execute this trade. You see this was a 2R on ES with the same TP. This is only a 1R on NQ. So something you want to keep in mind. I basically don't really take 1R trades unless I am purposely scalping. If I am purposely scalping and I just want to catch the initial reaction of a PY, 100%. I go for a 1R static for the most part, or something that's very conservative in terms of TP, in terms of internal structure. Else, I preferably want something that's about 3 risk reward for the most part. But here I couldn't really get that, and it's okay. Because I don't want to sacrifice getting stopped out on an A+ setup. Like obviously this worked here, but it's not, over the long run, you're gonna have a much lower win rate. So I prefer you keep the stop loss where I've backtested it, which is right here, right above the IFG. And you can see perfectly also, if you have the alerts on, IFG alert would send you an alert. My IFG alert or indicator will send you that alert, so you can get notified that there's an entry prior to price actually fully inversing with the body closure below it. But you can see IFG right here perfectly drawn out with the indicator. I don't draw my IFGs anymore manually because this indicator that I've custom coded just works perfectly and has, you know, tons of filtering systems with it. So, you know, it personally, to me, it's just the best thing that I could ask for. And this helps save me a little bit of time, you know, a little bit of hassle. That's all it is. And we later hit I didn't label the time frame on this POI. Hold on, let's see. Oh, I did. Sorry, 1 hour POI. Hit it later, 1 hour POI. Now, to me at this point, I know we hit 1 hour supply. What that means is we can get a high time frame reversal model. So these lows could be potentially weak now. We can anticipate them to be weak. I sent it out to Discord that I was gonna wait for basically this low to get swept, but you know, little emotional mistake I made. You know, it is what it is. I kind of took an L here because I didn't want to miss the move if this was the true move in expansion, and that we would not hold the supply. But the main confluence really here was we had this. We had trendline liquidity stacked right here. That is so perfect. Like, look at how perfect this trendline liquidity is. This is literally trendline liquidity. Everything is okay. Not everything is fully mitigated. Here's the thing. This is not fully mitigated, but that is not in this, or that is not in premium. I don't think. Let me see. That's not in premium. So you can see, since that's in discount, I'm not anticipating this to hold unless there's only one thing that could change this. If we get new range or new value added into the market. I made a few new videos in the course modules, like I said, discussing how you can identify this and basically better anticipate this so you don't get caught up basically trying to look for shorts up here when you can look for shorts right here in this new range. And that's literally what we had. We had new value and new range being made in the market. There's a lot of reasons why new value and new ranges are created in the market, but general sense of idea in terms of if you need a logical understanding, it's just volume and volatility. Whatever that reason is, you know, if it's because of news, if it's because, you know, timing, maybe for some specific reason, certain hedge funds or institutions or market makers just are not active on a given day during a specific time for some odd reason. It's not our goal or purpose to find out the exact reason. We just know it occurs in the market because of historical data on how price plays out, and I know that based on backtesting and just journaling my trades. Hence why in the beginning stage of your trading journey, you gotta be journaling. Otherwise, you won't be able to identify certain patterns that are literally happening right in front of you every single day, but you just don't memorize or realize it because you're too stuck up on your P&L. That's the problem a lot of traders have. They're not focused on price action, they're focused on their P&L, and they miss out on all this experience trading because they're not actually focused on what's actually important, which is the charts and not your profits. So I took a loss here, anticipating to run this trend line liquidity at least to its PY right above. And, you know, that to me, I guess it's still within my system in a sense. It's not like a emotional trade in a sense, entirely at least. But it is definitely a lower probability trade, knowing we did hit a high time frame. I told Discord here, and I have full self-accountability for my actions. I told the Discord, you know, I just got blinded basically by this trendline liquidity above. I really just wanted to see that get ran, but the market had other ideas, and that's when we stopped trading. And you can see this is at 1040. So what I hated and what unfortunately sucked was it would have lost on NQ the first attempt, but look at how well NQ held like this demand later on. Like we literally would have hit TP here. We literally ran all the trendline liquidity and this high here on NQ. This high right here got literally ran, which would be my TP as an SMT with ES, right? So if I just took this long here with my original long, my second entry on NQ, I would have been completely fine with a 4.6 risk reward. Or now here, I might have got stopped out here low key. This is something happened here. This is way after news. Whatever happened here, you know, if you just target trendline liquidity, like my initial trade idea, it would have been 3 risk reward. But holding through this is not ideal, to be honest. At this point, if I'm holding a trade and it's taking a long time, you make some discretionary decisions, which is, again, you can make it fully mechanical if you want. Me personally, I just step away for the most part from the charts, and I just either set my stop loss to break even, or if I have really high conviction in a trade, I just let it run. But I only let it run to a certain point, right? If it's taking 4 hours, man, I'm not gonna really be holding that trade, because for the most part, for majority of my trades, I know from my data, that's why data and understanding your data is important as well. Majority of my winning trades hit TP within 30 minutes or less. So I'm anticipating majority of winning trades that work are hitting my TPs I'd say within 30 minutes, so which is quite fast for a big intraday move, I'd say. So if it's taking hours and hours and hours, I'm not interested in holding that trade, man. I'd rather just take my profits and just let it go, and we move on to the next day or next session. So here, 11:11, we literally took a setup here, and you can see it worked perfectly on NQ. Would have hit TP, but we had huge divergence here with ES and NQ, unfortunately. And ES kept making internal lower highs and lower lows. So I got stopped out here on the POC entry. I took an IVG knowing that we had another sweep. We had an S&T plus a sweep. This makes it an A plus setup. This has failed as an A plus setup. So, A plus setups, they don't have a 100% win rate, guys. I trade based on probabilities, and probabilities is telling me it has about a 70% win rate. Sometimes 80%. It just depends if it's a continuation or not. To me, at this point, since we did take out or we did tap into 1 hour supply, it wouldn't be a really high probability A plus setup. But I would still want to take it. That's the thing. I was still want to take it. You put your money on the line where you think it's worth the risk or reward, essentially. Risk reward ratio is important. This to me, 4.7. I was willing to risk it, man. But it just didn't work, and it's all good. What's the main lesson here, though? The main lesson here isn't to predict if NQ is better or if ES is better. You will never know which asset would deliver more cleanly. There was another day, one of our trade members, he was trading NQ. We were in the same exact trade idea. Guess what? I think he hit his break even or stop loss. I can't remember entirely, but one of those two outcomes. And I hit TP. I think it was like a 3 to 4 risk reward trade and hit TP, right? That's a huge difference between stop loss break even versus hitting a 3 to 4 R, because you could be just done for the day by then. 3 to 4 R a day, consistently across a whole month. That's about 60 to 80 risk reward. A lot of people are not making that, man. Well, especially with their trading systems that aren't very good, or their understanding of prices is bad. They're drawing liquidity, things like that. It's very rare, very hard to do that consistently. And so it's just certain situations where NQ would deliver better, certain situations where ES would deliver better. I have not figured out any type of probabilistic way or method of figuring out which one would deliver better in which conditions. If you have, let me know, because I'll be very intrigued. I love the market. I love trading. I started trading because this was like a passion thing to me. I didn't start trading because of purely out of money. Short money was a thing. I was like, man, if I can make this passion and really invest in this passion, and I love learning about trading. The more I learn about it, I'm more invested in it. And if it could even make me a living, which it is right now, that'd be even better. That's like the perfect combination. Doing something you love and also making a living from it. That pays you very well. Now, obviously, the thing is, trading is still stressful as in nature. Trading is still stressful. You're not gonna have no stress at all trading, right? In itself, trading is a very psychologically demanding sport, if you want to call it that. It's not something that's physically demanding at all. We just click buttons, buy or sell on your computer, but it's very psychologically demanding, and you need to be prepared for that. Otherwise, my personal opinion, you might just not be fit for trading if you can't handle basically stress, right? And of course, you do build stress tolerance 100%. I'd say I built a ton of stress tolerance ever since my first time started trading, where I was so emotional and taking random trades all over. My executions, man, back then when I started was awful. It would be like sell, buy, sell, buy, sell, buy, sell, buy. You guys get the point. You guys know how tilting works, how emotional control works, things like that. We've all gone through that. But you do build a tolerance at some point once you truly understand your system and yourself, and you generally decide to stick to your rules and keep yourself accountable. That's all I can really say, man, because once you keep yourself accountable, you'll find red days a lot less and green days become a lot easier. For some reason, I thought this candle was moving for a second in replay mode. I was like, what? I got freaked out there for a second. Anyway, I took another entry here, took a loss here, and I was done. I was done for a day. You know what someone that's emotional would do? They would continuously trade this chop in this price action. After this, look, check the time, guys. Using time theory here, we've been delivering bearish for an hour and 30 minutes. This is not normal. And this is based on your data collection too. We typically, again, like I said, I hit TPs with normal structural moves in 30 minutes or less. This is way more past 30 minutes. This is almost 2 hours of purely bearish delivery, and we're just moving very slow. What does that mean? We're anticipating for a huge move to happen. Every time we consolidate like this, it is just institutions, big players in the market just iceberging their entries basically and trying to stack up as much liquidity as they can to then create a huge move. Whether that's in our favor or it's against us, that's not something we purely 100% decide. That's what the market decides. But the point is, you want to recognize that and just know this is bad price action and you should just stop trading for a day. Now, if you're on NQ, it looked definitely a lot better. On NQ, matter of fact, these huge ranges are very tradable on NQ. Like, you have a lot of setups here, man, on NQ. You have a stop hunter here. You have another stop hunter here. You can use this low for stop hunter. You have an OB entry model here later. You have so many entry models on NQ to trade this new internal swing structure. That's what I call it here, because external is still that high to this low. This is just internal swing structure. This here is basically what I tell you guys is a QM model. This is literally a QM model. You can see we later just dumped off the QM model. And we can anticipate this just based on how price action was previously behaving. We're not going to be able to predict, like, obviously in when you're live trading, you're not going to see any of this here, but you can anticipate price to deliver like this and being very choppy when price is already showing you its hand. We've been, again, like I said, delivering very bad price action for 2 hours or 1.5 hours. We're likely to continue. What makes you think we'll all of a sudden deliver very clean, right? You don't know exactly when that is. So I stopped trading here. A bad trader would continue trading this, probably get chopped up again. They might have taken actually their final winner here. Maybe, maybe not. But in a really choppy market, you'll just take losses after losses. And what tends to happen is traders tilt. And this is price action where people blow their accounts, whether that's personal, which you should never be blowing a personal because your risk should never be that high. I almost say funded accounts. This is where people blow their fund accounts, evaluations, whatever you want to, whatever you're trading, right? And looking back, you just think obviously you're dumb because you can see how you can early on anticipate bad price action, and what do you expect? Bad price action later, but you expected at that time good price action, even though that's just counter to what the market is basically showing you and telling you. So you have to really understand to adapt, and knowing when not to trade is actually a skill in trading that you develop over time. And honestly, it doesn't take too much time. This is not something that's some crazy 5-year plus trader experience thing. Literally, if I told, let's say someone is 2 months into trading, dude, in fact, if I give this to a high schooler, you can identify if this is good price action or bad price action just looking at this. This is obviously not the greatest price action here, and even worse here. So if you're still, after seeing all this, if you're still trading this, man, and you're not holding a trade, like if you're entered here, sure, hold your trade if you enter down here. But if you're trying to find a trade in the middle of all this or whatever, and you're not sure where price is going, especially if you don't have a drawn liquidity at all that's clear, you become a gambler at that point and not a real trader with a system. A real trader with a system, they like to trade deliveries where price has a very clean move to one side and typically tends to deliver very clean to the other side. Or a good trader likes to trade based situations where we do have, you know, some sort of solid range to trade with. Like we have a range here from this low to this high, or this high to this low. I can see an entry from a mile away right here, right? So again, just certain things in terms of price action you guys have to understand to basically keep your red days as small as possible. That's the gist of today's video, really. If you want to have one thing to take away, keep your red days as small as possible and let those winning trades days basically carry your account. Because the thing is, if you let your red days get big, it's going to have a huge psychological toll on you, and it could blow your account in a single day, right? You could have 19 greedy days. In fact, let's say you make 2 risk reward or 1 risk reward on those 19 days consecutively. You can lose 19 risk reward in a single day, guys. Because people that overtrade and start tilting, you could, if you want, you can go back and look at your trading history, but I bet you for a fact you take in at least 10 trades in a single day randomly. And these are not 10 valid setups. If you take 10 valid setups, for example, like me, for example, throughout 3 sessions, maybe across 2 assets, that's completely normal. That's not over trading. But if you're taking 10 random trades within a period of a 1 hour window, because there's not going to be 10 A plus or even B setups in an hour of trading, then you clearly know on one asset that you're clearly over trading and you're just not even a trader at that point. So you understand the exact reason why you ended red, and it's all your fault. You can't blame the market. This is just purely your fault. And you got to take accountability and move on, but move on with a new purpose and intent on your next account where you basically decide to follow your rules and not blow everything up in one day, right? Again, trading is not about effort and time that you put into the chart when you're actively trading. Yes, it's very important to put effort and time when you're studying trading, but when you're actively trading, it's just patience, guys. Patience pays. That's what I like to really use as a slogan. I think it's a very good phrase to learn and really just understand and apply to almost everything in your life, man. But especially trading, patience does pay. Waiting for these setups does pay. Waiting for the next day and is closing out your computer because you are continuing losses is also a valid strategy. Just wait until the next day. Maybe you're losing too much, not because of your strategy, but because of price action that's delivering bad. And it's counter to your strategy. That's completely all good. Just wait until the next day. Wait until price action clears up. And yeah, this is recapping my -1 R red day. I believe my other red day was -2 or -3 R. But again, thank you guys so much for watching. Join the free Discord if you're not in there. And I'll see you guys in either the Hunter Sword Advanced course or a private mentorship students. And I only have one spot left for that. And you guys can trade the WAP if you need pricing information and details on the mentorship. And I'll see you guys in the next one.